We've all looked at numbers on a page and felt completely lost. Rows and columns that seem to speak a language only accountants understand. But here's the thing. A balance sheet isn't just a collection of numbers. It's a mirror reflecting the true face of any business at a single moment in time. Think about your own life for a second. You own things, maybe a car, a laptop, some savings in the bank. You also owe things, student loans, credit card debt, maybe rent, and whatever's left after you subtract what you owe from what you own, that's your true net worth. A balance sheet works exactly the same way, just on a much larger scale. Let's start with assets, the things a company actually owns. Current assets are like cash in your wallet, ready to use right now. Cash itself, money customers owe you, inventory sitting in warehouses. These are the assets that keep the lights on. Then you have non-current assets, buildings, machinery, patents, brand names. These aren't going anywhere fast, but they're the foundation everything else is built on. Liabilities, what the company owes to others. Current liabilities are the bills due soon, suppliers waiting for payment, short-term loans, salaries owed to employees. These create pressure. Long-term liabilities are different, mortgages on buildings, bonds that won't mature for years. These are calculated burdens, bets on the future. Consider this perspective. Two companies each owe $1 million. Company X owes it all within the next 3 months. Company Y owes it over the next 10 years. The number is identical, but the reality couldn't be more different. Then we arrive at the golden number, shareholders' equity. Assets minus liabilities equals equity. It's what the owners actually have claim to after everyone else gets paid. Retained earnings, the profit a company reinvested. Common stock, the original money owners put in. Each component tells you something about the company's journey. But here's what most people miss. A balance sheet isn't meant to be read alone. You need to compare. Look at the same company 6 months ago, a year ago, 5 years ago. Are assets growing or shrinking? Is debt increasing faster than assets? A single snapshot shows you where someone is standing. Multiple snapshots show you where they're going. The current ratio is crucial. Take current assets and divide them by current liabilities. If you get a number above 1, the company can theoretically pay all its short-term debts. But context always matters. A ratio of 5 might mean they're hoarding cash instead of investing in growth. The debt-to-equity ratio tells another story. How much financing comes from borrowing versus ownership? High debt is like racing downhill, fast but dangerous. Low debt is like climbing steadily, slower but far more control. Negative equity, when liabilities exceed assets. This isn't just a red flag, it's a siren blaring. It means the company owes more than everything it owns is worth. Some companies recover from this position, but many don't. The beauty of mastering balance sheets is that it changes how you see everything. That startup everyone's excited about? Check their balance sheet. That corporation claiming strength? Check their balance sheet. Numbers don't lie the way press releases do. Balance sheets aren't static documents gathering dust. They're living reflections of thousands of decisions made every single day. Every sale, every purchase, every loan taken. All of it shows up eventually. Learn to read it, and you're reading the story of the business itself. Understanding balance sheets isn't just an accounting skill. It's a life skill. It's the difference between investing wisely and gambling blindly. The numbers are there, waiting to tell you the truth. All you have to do is learn their language.